I'm Joanna McGinley. I lead Redistributor Solutions at Morningstar. And through CFA Society of Chicago, I am also a member of the Lunch Programs Advisory Group. Our distinguished speaker today is Charles Evans, President and CEO of the Federal Reserve Bank of Chicago. In this capacity, he serves on the Federal Open Market Committee, the Federal Reserve System's monetary policymaking body. As you may know, the Federal Reserve Bank of Chicago is one of 12 regional reserve banks across the country. These 12 banks, along with the Board of Governors, make up our central bank. As head of the Chicago Fed, President Evans oversees the work of roughly 1,400 employees in Chicago and Detroit who conduct economic research, supervise financial institutions, and provide payment services to commercial banks and the U.S. government. Before becoming president in September of 2007, he served as director of research and senior vice president, supervising the bank's research on monetary policy, banking, financial markets, and regional economic conditions. And prior to that, was vice president and senior economist with responsibility for the macroeconomics research group. Please join me in welcoming Charles Evans.
Thank you. Thank you, Joanna, for that nice introduction. It's a great pleasure to be here at the Chicago CFA Society. I've had the pleasure to speak before this group on at least 2 occasions, and it's always a very informed group. And now I understand you have a webcast group as well, so I'm happy to speak in front of everyone. So today I'd like to just speak about the U.S. economy and monetary policy and how I see things going, and then afterwards, I'm happy to take your questions. So the U.S. economy seems to be performing pretty well right now. We are improving quite a lot, and that's a good thing because we're continue to face substantial headwinds. I mean, after all, we had this very large downturn in 2008, and the economy finally bottomed out in the summer of 2009. And we've had a recovery ever since 2009, and yet it's been rather a moderate recovery, and the unemployment rate has been very high throughout that time period. So it's wonderful to have the U.S. economy improving. And I'm confident that currently we have the appropriate monetary policy in place to support this economic growth, so that we should build momentum throughout the rest of this year, and it should become self-sustaining growth in 2014. Just to give you a couple of details on this, I'm looking for GDP growth this year to be about 2.5%. And then next year, I'm looking for growth in the 3 to 4% range. I think probably 3.5% as we achieve launch velocity and the economy builds momentum. The most recent data actually have been pretty decent, and we tend to expect that growth in the first half is going to be 2.5% now, maybe 2.25%. So we'll get a little uplift in the second half of this year. Data have been pretty good, although mixed. We've seen improvement. It's been a little bit mixed. I've been saying that my outlook is for 2.5% this year ever since the beginning of the year, and so we've gotten a good bit of data since then, and it's been up, it's been down, but I think it hasn't changed materially since that relatively optimistic forecast that we put together in January. Business spending has softened a little bit, and consumer sentiment also has been soft. It's been up and down. Most recently, when I've called around, I talked to a lot of business people before FOMC meetings. We have advisory groups as well that I try to get a sense of how things are proceeding. We have our own beige book that we look at and publish before meetings. And I have gotten the sense that before the last meeting over the last month that some of the business indicators have been a little bit softer than we would have expected. But I think that this is still not something to get overly concerned about, but we're monitoring it very carefully. The employment picture has been improving, and the jobs numbers were recently revised up. And so that's good news, and that's especially good news given all of the headwinds that we're facing from the fiscal side, the global weakness around the world, and other things. And household spending has been really quite good, and they've maintained a good pace of growth in the face of the tax increases that came about at the end of the last year, and we've been having to deal with this year. The payroll tax increased by 2 percentage points in January, and you begin to wonder, given the strength of consumer spending, whether or not people have actually noticed and looked at their paychecks. Maybe they've been continuing to spend without reference to the fact that their take-home pay has gone down a little bit. In another world where employment was really roaring along even faster than what we're seeing today, maybe we'd be seeing income growth that would be overcoming that. I think we're going to have to pay attention to that, whether or not we're going to continue to see headwinds for household spending the rest of the year. But so far, this has been really very, very good. And in fact, if it weren't for the fiscal drag, if it hadn't been for the tax increases that I talked about, the previous reductions in government spending last year and now the sequester, then that we estimate that growth is being reduced by 1.25 percentage points due to all of those things. And so looking at 2.5% growth, we'd be in excess of 3.5% if we didn't have the fiscal drag. So the private sector is actually doing really quite well, and that's encouraging. And then at the same time, inflation has been falling. We have recently indicated back in January of 2012 that our long-run inflation objective is 2% on the total personal consumption expenditures index, and we've been underrunning that 2% now for quite a period of time. And year over year, inflation has been running at about 1 percentage point. So that's really quite weak relative to our objective, and so we would like to see inflation closer to our objective. But we do have good monetary policies in place now, I would say, and they're supportive of the continued growth that I expect, and I think we should achieve escape velocity in 2014. Okay, let me talk about our accommodation. We have been doing a lot of things. We've had the short-term policy interest rate at 0 since quite a long time. December 2008, we've indicated that we're going to continue to keep rates very low for quite some time, and we've also been doing asset purchases quite a lot. I would say that we have been trying to deal with an intense deleveraging process that the U.S. economy has been going through, that households and businesses who had previously had a lot of debt on the books, their balance sheets, decided that they needed to have less debt, they needed to pay it down, and so we've been going through a tremendous deleveraging process, and risk aversion was very high during this time period. But our policies have tried to facilitate that improvement, and I think the financial markets now recognize that the low returns on super safe fixed income assets are here for a long time. So if you want to seek higher returns, if you want to do better than what you've experienced over the last many years, and if the risk aversion is giving way to better risk-taking appetites, then investors are moving into other asset classes, and I think these are asset classes that are going to more directly bolster spending for the economy, that are going to eventually lead to more investor capacity expansion, and that's a good thing. Our accommodative policies are supporting the normal cyclical recovery that should be taking place right now. We've had extremely moderate growth after a very deep downturn. Auto sales for a long time were very weak. There's a tremendous amount of pent-up demand out there, and our lower interest rate policies are helping support satisfying that pent-up demand. So auto sales are now back up to the 15 million per year range after being down around 8 or 9 million at the depths of the recession. So things have really turned around a lot there. Auto loan rates are lower, and that's helping. It's also the case that mortgage rates are a lot lower, and the housing market is beginning to experience a revival. Housing starts are up quite a lot. The foreclosure process seems to be the markets are able to deal with the foreclosures that are coming online, and in fact we're hearing more and more reports about how it's hard to find good houses on the market. They're snapped up very quickly. Our lunch table had a discussion just about that, especially in the key areas where you really would like to find a nice, attractive house for families, they're going very quickly. So I think those are all good signs that our policies are having an effect and the economy is doing better. I do think it's important not to be complacent, though, about this. We continue to face powerful headwinds. The fiscal situation and the global economy is very weak. The data have been choppy, and that reminds us of these downside forces. Now, in terms of monetary policy, what are our policy tools? At the moment, they're twofold. Our policy goal is to provide monetary and financial conditions to support both price stability and maximum employment. So, price stability, I mentioned just a few minutes ago that we are targeting 2% inflation over the long run, and we've been underrunning that. Then on the real side of the economy, we've tried to point to what a sustainable level of unemployment is that would be consistent with maximum employment. And we've most recently sort of indicated that according to our forecasts, it looks to us like either 5.25% to as much as 6% unemployment is a level that's most associated with sustainable rates of unemployment. At the moment, the unemployment rate's 7.5%. And I think that sustainable rates of unemployment are a lot closer to 5.25% than the 6%. But even if you're conservative in your assessment, there's still quite a wedge of improvement that's needed to bring the unemployment rate down. So those are our goals. And at the moment, we're missing on both of those goals. Inflation is lower than our objective, and unemployment's too high. So we have two policies in place. We've got our low federal funds rate policy. The funds rate's essentially at zero. And for quite some time, we had just indicated it's going to be zero for an extended period of time. And when it wasn't obvious exactly how much accommodation we intended to put in place with that type of description, we eventually said, well, it looks like it's going to be until mid-2013. In August of 2011, we had an FOMC meeting, and at that meeting, we decided we wanted to add more structure to our forward direction, and we said, oh, it looks like it's going to be about 2 years. 6 months later, the economy wasn't doing as well as we thought it would, and we said, now it looks like it's going to be as late 2014. So one problem with that type of calendar date guidance is every time you tell people that it looks like it's going to be further in the future, you can't tell the difference between whether or not we've decided that we need to add more accommodation or we're just doing the same thing, but things are a lot worse. The economy's gotten, worse, and so that seemed to be something we wanted to provide more information on. So I had certainly gone out and talked a lot about how we could improve upon our forward guidance by indicating what our objectives were. So I said, we're looking to, get unemployment down to its sustainable level. That's 5.25%. But we're going to keep the funds rate at zero for quite a long time. Why don't we say that, we're going to keep going until unemployment gets much closer to that, say 6.5%. And that's the kind of policy that we have right now. We're going to continue to have the funds rate at zero until unemployment is at least as low as 6.5%. Now you have to be careful about that because it could be that things work out differently than you think. So what if inflation were to become too high with a policy like that? Maybe inflation would take off. So we have an inflation safeguard as well, and we said we're going to continue with the funds rate at zero until unemployment gets much lower unless inflation starts to rise. And so if the inflation outlook is for 1 to 2 years ahead at 2.5%, that's against our 2% objective, so it's a 0.5 point above our objective, then we'll step back and think about whether or not we have too much accommodation in place, and then we have to recalibrate. So I think that adds a lot of additional guidance and certainty as to the conditional policies that we intend to maintain, and so I think that's helpful. Then after that, we decided that we also have decided that we want to buy long-duration assets in order to provide even more accommodation in an attempt to reduce longer-term interest rates. And so we've been buying $85 billion of long-duration assets split roughly equally between treasuries and mortgage-backed securities. And the idea here is that we want to jumpstart this recovery. So we've been doing this since September. of last year, and we're going to continue to do this until we see substantial improvement in the labor market outlook. Now, we've seen good progress in the labor market outlook because back when we adopted this policy, the unemployment rate was above 8%, and our assessment of how employment was going to improve was not quite as good as what we've experienced so far. So we've seen better reductions in unemployment than at that time when we adopted the policies, and we've definitely seen improvements. I think the question right now, in order to assess it whether or not it's been substantial enough, is how much confidence we have that the improvements that have been made will continue and be sustained. So I said some time ago that one measure of when we'd see substantial improvement is if payroll employment jobs every month were increasing by 200,000, and if we got something like that for 6 months in a row. And we have seen payroll employment averaging above 200,000 for the last 6 months, so that's a really good thing. In my mind, what's most important at the moment is whether or not those numbers, we can expect them to be sustained over the next many months and then increase beyond that. I'm very hopeful. I think that I'm very gratified by the improvements that have been made. I think our policies have been important for turning that around. I think we need a little more time to assess that. Okay. So, one thing about our forward guidance on the 6.5% unemployment threshold, I would say that if we are going to be, suppose we get to the point, and currently our assessment is this is going to come sometime in either late 2014 or in the spring of 2015. The unemployment rate's coming down. Suppose we get down to 6.5%. Suppose we get down to 6.4% unemployment. Then I think it's important to think about our policies in terms of them being a threshold, which is let's look at how everything else is doing. What's inflation doing? If inflation were above our 2% objective, and if it was expected to stay and even increase, then that probably, almost surely, would mean that we should start backing off our accommodation, that we've been successful, and it was time to bring things in a little bit to reduce the amount of accommodation if inflation was a problem. But imagine that inflation was only 1.5% as measured against our 2% objective. Then I think we could continue to have the accommodation until we saw greater inflationary pressures, until we got it up until to the point of our longer-term objective. So I think we need to, in thinking about when these policies will end and we'll start recalibrating, we have to look at both sides, the employment side and the inflation side. And it's possible that we could keep going even beyond that 6.5% threshold. I think that's very important because we definitely want to average 2% inflation over a long period of time. One of the benefits of saying that we have a 2% inflation objective is that you're going to average that, because the benefits are, borrowers have a good idea of what the real burden of their borrowing is when they know that inflation is going to be low and doesn't change very much. And then lenders know exactly what they're getting for lending out their funds, and so they're willing to do it, even more because of that certainty. And so it's very important that we maintain that. We wouldn't want it to be too volatile. That would be very costly, like in the 70s. But we wouldn't want it to be either too high or too low, because that would disadvantage either borrowers or savers, depending on how that comes out. So over a long period of time, we'd like to average 2%. 2% is not a ceiling. So when I see year-over-year inflation today of 1%, that's why I say we want to get that up to 2%. We want people's expectations to be that they're closer to that, so that their borrowing costs aren't higher than they expected, or on the other side of that, that lenders didn't get an adequate return for putting their funds at risk. So I think that's my statement of how I see policy today. I think that we're facing a lot of headwinds. I'm very optimistic about how we're doing, and the economy must be, underneath all of this, really quite resilient if we're able to generate 2.5% growth this year in the face of a 1% or more drag. I'll sort of end with the following note, which is, in spite of my optimism, I am a little nervous that we've been going through episodes like this for the last 3 years. For the last 3 years, I've had a very similar forecast, which is going back to the early 2010. Moderate growth, then we're going to get to escape velocity, and we're going to launch from there, and we're going to get 3.5% and 4%. We're going to get out of this. That didn't happen in 2010, and we had to embark upon our QE2 program in the fall of 2010. 2011, moderate growth, then expansive growth after that. That didn't happen. We had to embark upon forward guidance with calendar dates. We had to embark upon Operation Twist at that point. Then in 2012, we needed forward guidance. So I'm optimistic that this is the year where we really turn things around, but we've been in this situation for a number of years, and there are other countries that have had quite large challenges, like Japan. Wouldn't want to end up like Japan, wouldn't want to get close to that. We just want to get away from that. So, in conclusion, let me just say that I think our monetary policies are still very supportive of the economic growth that we've seen. I'm optimistic that they are working and that we're going to get unemployment to be coming down and inflation will go back up to 2%, and things will work out pretty well. So I'm going to stop there and happily take any questions that you have.